Sammy owns a truck worth $40,000. He's concerned that his truck might be damaged in an accident or even stolen. So Sammy decides to buy a zero-deductible insurance policy, or a put option, on the truck for the full amount of $40,000, which would be the strike price, from Susie's Auto Insurance Company. Susie charges him $1,500. That would be the option premium for a one-year policy, 1 year being the expiration date. Now, three things could happen in this story. In the first scenario, Sammy's truck is not damaged or stolen during the year, so Susie keeps the $1,500 premium. Sammy's okay with losing the $1,500 for the protection it provided him for the year. In scenario 2, Sammy's truck is damaged in an accident, requiring $10,000 in repairs. He exercises his insurance policy, or his put option, by filing a claim, and Susie pays him $10,000 for the repairs as agreed. Sammy is happy he purchased protection for this possibility. In the third scenario, Sammy's truck is stolen. He exercises his insurance policy, which is his put option, and files a claim, but this time for the full replacement value of his truck, and Susie pays him the full amount of $40,000 to buy a new truck. Sammy, of course, is very happy he purchased protection for this possibility. In any case, Susie's happy because she sold many such insurance policies, different put options, to other drivers, most which never filed a claim or never exercised their options, providing her with a net profit overall. And here's a footnote to this story. If Sammy had a poor driving record, that's more a risk to Susie, so she would have charged him more than $1,500 for the one-year insurance policy. On the other hand, if Sammy had an exemplary driving record, Susie could have charged him less, as the risk would be lower. Likewise, with put options, the higher the perceived risk, the higher the premium demanded by the market. Let's look again at a definition and a trading example. A put option, then, is a contract between two parties to exchange a stock, or an ETF, at a strike price by a predetermined date. One party, the buyer of the put, has the right but not an obligation to sell the stock at the strike price by the future date, while the other party, the seller of the put, has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go down to $40, you might buy a $45 put option for, say, 20 cents. If the stock dropped to $40, that would allow you to sell the stock at $45 even though it's valued at $40, netting you a $4.80 profit on each share. On the other hand, the person that sold you the put would be obligated to buy the stock from you at $45 at a loss of $4.80. If the stock never drops below $45 by expiration date, the put expires worthless and the put buyer is out 20 cents and the put seller keeps the 20 cents.